Hello, investors and traders, and welcome to the weekly market report with the Market Guys. I'm AJ Monty, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. Basically, this trades 1/100th of the Dow Jones Industrial Average. And as you can see, I left my lines on the chart from last week's report so you can see how accurate the forecast was. And this is the line that I drew last week when we closed last Friday. I said that we would most likely go up to test this resistance point, which is the high from the 29th of April. And I drew that as what's called a horizontal flat line. And you can see that the markets did move up a little bit on Monday and Tuesday, but on Tuesday, the market closed with a bearish engulfing pattern and then moved right back down to, guess where? This gap fill support level. You see this? So what does that mean for next week? Well, if you have been following along with our trading checklist, you'll know that we start off looking at the type of candle and the pattern that those candles form. And as you can see here, as we close on the 15th of May, we close with a slightly higher high and a higher low. So this, by definition, defines that pivot point. Now, on the way down, you can see that we had a drop in volume today, about a 20% drop in volume from the previous day, and that tells us that the sellers are losing their momentum, and the stochastics is starting to turn up. Now, the most important oscillator that we're looking at today for the diamonds is the CCI, that's the Commodity Channel Index. And as I zoom in here for you, you'll see that this blue line, which is the indicator itself, is crossing over the green line, which represents the minus 100 mark. Now, when that happens, the minus 100 mark is the oversold condition. But when it crosses back up over it, that's where the buy signal is created, right there. See that? So we're going to forecast that we're going to move up next week. And again, test this resistance line. You see, we're basically caught in what's called the trading channel. If I go to this low and project out and connect it to this, you see that we have two parallel lines running, support on the bottom and resistance at top. So most likely the markets are going to stay within this range. Now, if we look at the Qs, which is basically the ETF that tracks the tech sector, you'll see my forecast lines were in place again. I said we would move up and then pull back. That's exactly what happened. On Tuesday, again, a bearish engulfing pattern. And we pulled back to the 20-day moving average. Let me zoom in a little bit more here for you so you can understand what's going on. This low from Thursday coincides with a gap fill from the gap back here. You see that? Now, we have a set of rules that we use for trading gaps. It's our gap trading strategy rules. And basically what those rules state is that, number one, 80% of the time gaps fill. So this gap has filled. So that's out of the way. But the second half of that rule is once the gap fills, there's an 80% chance that the market will reverse from the gap fill point. So chances are we're going to move back up and again test this resistance right here. So I'm forecasting a fairly narrow range next week for the tech sector, and we'll have to see whether or not we break out over this resistance point right here. But again, we're caught in a channel right there, and so I think the next week ahead is going to be upward movement to test that resistance as well. Now, looking at the Russell 2000, which is a more broad-based index, but it tracks more or less the small cap stocks, you'll see that we did pull back from resistance. Again, I drew that flatline resistance. We didn't go up as high as I thought we would, but look at that. We filled this gap and then pulled back. See this gap right here as I magnify that? That is a gap fill point. 80% of the time it pulls back. There you go. We have it. So for the Russell 2000, we have some other signals that we want to pay very close attention to. First of which, as I zoom in here, you'll see that Thursday we have this pattern, which is known as a hammer pattern. A hammer pattern is a small-bodied candle found at the end of a downward leg. This is a down leg here. And the shadow, or that vertical line that falls underneath that candle, the shadow needs to be 2 to 2.5 times the length of the body, and we have that. So that's a bullish condition that is formed more or less at a support level. So with all the indicators pointing up again, and even the CCI here on the Russell 2000 is crossing with a buy signal as it travels over that minus 100 mark, that green line. Again, I think the Russell 2000 will move up. First level of resistance is going to be right here from Monday, and we're going to expect it to gravitate up and again stay within this range. Now, as we move into the last index, and then we'll cover the VIX after that, looking at the S&P 500, which is SPY is the ticker symbol. I said we would have to test to see whether or not we break out of that resistance. We did not. In fact, it held the line that I drew last week, that horizontal resistance, formed a bearish engulfing pattern right there. See that? Pulled back, came close to forming a hammer pattern, but not quite, because this shadow is not quite 2 times the length of the body. But that shadow is long enough to tell me that the buyers are coming in on that day, yesterday, the 14th. And so I think we're going to move up on the spiders as well. Now, you have to be careful. These are not guarantees whatsoever. If you're watching the markets very closely, you'll know there's a lot of news, geopolitical news, economic news, unemployment news, you name it, it's coming out. And on any given day, the tide can shift and go the other way. So we have to be very protective of this market, or any positions we have in this market. This is the flatline resistance area that I'm going to draw here for you as the target. Indicators are pointing higher. The buy signal is happening on the CCI, and that's our forecast for the spiders. Again, with this being more or less in a parallel or sideways trading range. So now finally the VIX, VIX, this is the volatility index. We follow this as a leading indicator, but remember it's inversely related to the S&P. This held as support like I said it would. We bounced. Resistance was holding at the 20-period moving average, but look at the oscillators. Look at that. Stochastics is hinging lower, and so is the CCI. The CCI did not get to an overbought condition, but it is hinging lower and now passing down below that momentum line, or the zero line, which is that black line. So what do I think is going to happen with the VIX? I think we're going to move lower to test that support level. Now remember, some weeks ago, I pointed out the gap down here. I'm not going to say that gap is going to fill next week, but there is a good chance that the gap will fill eventually, because 100% of the time, gaps on the VIX fill, because it's not a stock that trends. It's an oscillating index that oscillates between highs and lows. So while the VIX is dropping, that might be short-term bullish for the market. We have to still be very careful because there's so much news out there and uncertainty with regard to these lockdowns and quarantines and such. So people are getting very irritated in different states. We don't know how that's going to play out, but I'm sure the market is not going to like that. Eventually, the market likes stability. It likes steadiness. It likes steady growth and price action. We're obviously not seeing that, so we have to be very careful. Now, this coming Monday, we are having an open house Q&A session, and that is going to be on May 18th. If you see down here as I magnify that, we had a time change. We changed it from 8 p.m. to 8:30 p.m. to accommodate those that live on the Pacific Coast. So we're giving them an extra half hour to prepare and get ready for that. If you want to register for that, just go to our webpage, click on the Register Now button, and that will bring you to the registration link. Now, with regard to the gap rules, if you go to the video tab on top, we have a video that explains gaps and how to trade them. You scroll down just a little bit, and it's right here, third row to the right, trading the gap. It is right next to the 1% rule. I would encourage you to look at both of those, starting with the 1% rule, because it's most important now that you manage risk according to the volatility and make sure you're minimizing that loss when, not if, but when the market turns against you. We're never guaranteed to get 100% profit on our trades, but for those who are position traders, you apply the 1% rule to each and every one of your positions and then rely on your trading ability and strategies to make up the losses that you're incurring in those smaller positions. Okay, so that's it for now. Hopefully we'll get to talk to you on Monday, and I am really excited about that. It's 1 hour action-packed. Meet me there, and I'll answer your questions and analyze your stocks. So take care. Have a great weekend. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.